Good morning, good afternoon, and good evening. As we all know, this is Joseph Trevisani with my monthly, for some time now, a seminar, a webinar, discussion, lecture, whatever we'd like, for FX Street. Today's topic is one of my favorites because it looks into the future. I've written on it sometimes, a number of times in my column, and also commented on it and made appearances about it. One of the things, of course, that all traders try to do with different horizons and with different degrees of success, of course, is to look into the future. After all, what is a trading position except a bet, a hedge, a judgment on the future? For an individual trade, the parameters are narrow, and yet, as we all know, trading itself is fraught with difficulty. It's not an easy thing to do to predict the future. I think if we somehow ended up back in time discussing things with the priests in Ur or in Babylonia or in Nineveh, one of the things we would find that we could discuss in common is the future. Their view of the future, how they went about predicting it, what they thought was important. Without being too grandiose, that is what I'm trying to think about in this column. The largest movements in economics, and one could say in history, and probably in interest rates and other things, are not and in currencies, which is where we're going with this, I think are not as determined by specific fundamental factors as we think. What do I mean? That the evolution of the dollar as a reserve currency, replacing the British pound, and perhaps now that we're looking into the future, something else, if not supplanting, certainly taking part of not totally supplanting, but certainly taking a good portion of the U.S.'s role as a reserve currency. These are not necessarily things that are planned. They almost seem to be inevitable. One of the things, and I'm not saying that the U.S. role, the reserve role of the U.S. currency is headed for an inevitable change, but I'll lay out my thoughts on it going back to the British. During the British economy was the first economy to industrialize. So its position in the world, its acquisition of wealth, its ability to support its population, and its ability to project power and to export its population. One of the things that is striking about the British Empire is the amount of people from Britain that were willing to go halfway or all the way around the world to start some sort of new life. You did not find the same type of willingness in prior European empires or in ones that were current with Britain, such as France. One of the reasons, not the only reason, but one of the reasons, is that the Industrial Revolution in Britain provided a great surplus of population. The Industrial Revolution and one could say the Public Health Revolution, such as the purifying of water and the recognition that many of the earlier diseases were waterborne. But at any rate, this gave Britain a population to export, which it basically did. The Industrial Revolution, which was helped by this, of course, gave Britain the power to project around the world. That power was both military, but it was also, and I think primarily, economic. The dominance of British manufacturers in the early part of the 19th century and well into the 19th century until they lost the lead as the dominant industrial power in the latter part of the 19th century to both the United States and to Germany was the reason that the pound was the standard for world currencies. It was the reason why London was the financial center of the world. These things followed the development of the British economy. You can obviously make a very clear and obvious parallel to the United States in much of the 20th century. New York became the financial capital of the world, although London is still very important, and you could make an argument perhaps that it still is. I would say New York is, certainly up until 10 years ago. It's in debate perhaps right now. And the reason the dollar became the world reserve currency was because the U.S. was the dominant economic power in the world. More people wanted to trade with the United States, more trade took place with the United States, more resources were consumed here and still are, much of the early exploration for resources was conducted by United States companies. So many things led to the dollar being the world's dominant currency. But the primary fact is the economic dominance of the United States in much of the 20th century. Certainly from the end of the First World War on until the collapse of the Soviet Russia, and probably well up until 2000 would be my guess. One of the things that's interesting about these types of long movements is the economy grows first. The economy also declines first. The political and military power catches up in the beginning to the growth of the economy. For instance, Britain was long thought to be the dominant political power in the world when her economy had long since given up being as dominant as it was, no longer as dominant as it was. And in fact, the appearance of military power and political power collapsed in the First World War. Although Britain and France won the war, at the end of the war, not only was it obvious that their economy was shattered, but so was their political power. It lingered on through the 30s in sort of a twilight. They really could not project power. They had not the money to do it. They had not the will to do it. Now, this had been retreating. Their economy had been retreating for a long time from its dominant role, but it was still assumed that their military and their political power was still dominant. It took the kind of catastrophe of the First World War to show that that wasn't true. There are parallels here also for the United States. Now, I'm not trying to be a political doomsayer here or anything, but I am looking at what are the largest currents, I think, in the current economic situation. Certainly it seems to us that things are, just as consumers, as voters, as observers, as readers of the news all around the world, not just here in the United States, but in Western Europe, in Asia, in many other places, that something is going on, that changes are happening, that the trends which have been building for the last generation are now making themselves felt above the horizon by concrete political acts. By the way, I will be traveling for this month. I hope I'll be able to conduct some webinars. If not, I will try to write my column involving the road and the countries that I'm going to. Next week, I will be spending a week in Kuwait. We do a lot of business there, and I think there'll be some very interesting opinions that I will gather, and I will certainly try to put them in my column so you can all know. And then I will be spending 2 weeks or more in East Asia, in Singapore and in China. And since the column that I'm writing, speaking about today, the topic today is about China, it should be extremely interesting. Just as a private note, I have not been, I was in Shanghai 25 years ago, 23 years ago when I was in grad school. And it really had not changed very much from the communist days, although Mao Zedong was dead and Deng Xiaoping had just recently, a few years before, announced their conversion to the capitalist road. Very little had been done. There was one department store on the Bund in Shanghai. There was one hotel. And as a poor graduate student, and I was a poor graduate student, I could afford to have dinner in the fanciest hotel in Shanghai on a graduate student budget. I do not think that would be possible now. In fact, I know it's not. But I will report back and see what Shanghai is like 23 years later. A very interesting set of bookends for today's topic and for the Chinese economy and political system and the world financial system in general. That quarter century really does mark the two outsides of Chinese economic development. In 1986, there was none. And they had no real effect on the world. The only real effect the Chinese had on the world was through the People's Liberation Army, which fought many wars in pursuit of its political goals. And now, how do the Chinese affect their power in the world? Through the American bond market and the treasury markets. This is a rather astonishing change. But let us get specifically to our topic and see what we have here. I have two titles for today's talk. The one that I wrote up was, Does China Have a Lease on America's Future? I thought of a better one, a little more dramatic. It's from an August Strindberg play called The Dance of Death. I saw it a number of years ago on stage in the city with Ian McKellen and Helen Mirren. It is a rather typical, dour, and, how shall we say, meditation on death by a Scandinavian playwright. I believe he's Scandinavian. I think he's Swedish, but I'm not sure. However, the two actors were probably the best things I'd ever seen on Broadway. But anyway, so we can also call it The Dance of Debt, China and the U.S. When the financial crisis was at its peak late last spring, one of the most dire futures for the American economy was calculated on the idea that with the enormous amount of debt that the U.S. could not afford and was tripling to help get through, stave off the collapse of all the things we remember. And then with the new administration, all of the, at that time, yet projected, and still projected, they've not actually been put into budget form nor have they been passed, spending plans, the assumption, and a very good assumption, no, we're still looking at the bond, the 10-year generic bond yield. It's probably not going to change very much. May change the parameters on it, but that's really what we're looking at. The greatest problem that everyone was looking at was, would all of this enormous amount of debt leased on the world force bond rates up because people did not want to buy one without assurance, and because the enormous amount of liquidity that the Fed and other agencies were releasing into the world would inevitably lead to dollar devaluation and inflation. That, if that comes to pass, and if the bond buyers of the world, including, of course, our primary country that we're concerned about, China, took that attitude, then the ability of the United States government to stabilize and revive the U.S. economy would be severely limited. The financial crisis began in the housing market, and with housing rates at 4.5% then or 5%, there was some hope that things would stabilize. And in fact, they have stabilized to some degree. But the great fear was that if rates rise, and remember, the Fed sets the rate on the Fed funds target. It does not set market rates for other types of instruments. Many of them key on the 10-year Treasury, some of them key on LIBOR. These are market rates. So if the Treasury prices went down, and went down dramatically, as perhaps people thought they were going to do, then the rest of the rates in the economy, primarily the mortgage rates and others, would follow them higher. And that would be it, or could be it, for any revival of the American economy. So it was crucial. And the Fed outlined its concerns about this in something that was very dangerous, and something that they pulled back on. And that was, of course, their entry into the Treasury market, where they agreed to buy $300 billion worth of American Treasuries. So that is not in effect. That is in fact direct monetization of the U.S. debt. That also gave the dollar its greatest daily weakness. I don't have the exact time frame, but probably in about 2 years, maybe more. I believe the euro fell about 4 figures that day. The dollar fell against about 4 figures that day against the euro. So, the Fed and its plans to buy more debt, this is aside from the $1.45 trillion that the Fed was already pouring and still pouring into the MBS markets and housing markets, the housing debt markets. That the greatest problem that the Fed was facing at that time was if it announced anymore, and we saw this at the last several FOMC meetings where they did not increase the purchases of Treasury. Now, what we're looking at here, and I know we've talked about this before, I just want to make it very quickly, this particular run right here. This run down, of course, is, as I've said, risk aversion. It is everybody piling into the dollar. It is not a fundamental or an economic move. It is not based on interest rates. It's not based on anything except I'm going to lose my shirt. Let's put it where perhaps I won't. That's all that's about. So this return here, which of course was started by, or the way it's displayed, is by falling debt price, falling bond prices, because we all know that the bonds go up, the rates go down because the rates are fixed. This fear right here was the thing that prompted the Feds to become concerned that rates would really balloon up and that they needed to do anything. Someone says they can't see my chart. Let me just make sure. I'll do this again. Let me know if anyone else can't see the chart. Hang on a second, and I will check. The chart hasn't changed, actually. It is just a 10-year generic bond yield for the U.S. Treasuries. It is a Bloomberg chart. That is correct. I am a recent convert to Bloomberg's information system, and I understand why Mr. Bloomberg is so wealthy. It really is a good system, and I don't know how I ever get along without it. But be that as it may, let us move on. So the dollar had the greatest potential check. Currency traders, we all had the greatest potential check on what the Fed was planning to do to reflate the economy, because if the dollar collapses, then all bets are off on treasuries, on the U.S. economy, on U.S. interest rates, on the U.S. consumer. That did not happen. One can make arguments about why that was the case. I think probably that the greatest effect and the greatest stabilization, because no one knew what would happen. No, we had never entered. We have never been in a financial world with these types of numbers, these types of plans, these types of events. These are new things. But at the time, one of the things that was very closely watched and very closely listened to was, of course, the topic today. What did China think? But more importantly, what did China say? But most importantly, what did China do? Now, the Russians, of course, were very vocal as well. And as they were paid attention to, but their commitment and their involvement in the American Treasury market is several magnitudes lower and smaller than the Chinese. The Chinese, with the amount that they already owned, the amount that they potentially could buy, the need of their surpluses to be put someplace, and their very evident economic maturity. What do I mean by that? As I said earlier, the last 25 years in China have to be one of the most astonishing and successful accomplishments of any society and any culture that I know of. It is impossible not to take the Chinese seriously, since they clearly take themselves very seriously. Or as somebody said about Angela Merkel, I think it's Angela Merkel, actually. Recently, she's the only adult currently on the international political scene. I don't know if I agree with that, but it's kind of a cool comment. So the Chinese and the Russians gave the Americans a very serious series of warnings about the dollar. And remember, what they focused on was the dollar, because at the time, as we noted, it looked like the Fed was planning to directly monetize the debt because it had no choice, and that effect on the U.S. economy, as we noted, through the dollar, would have been dramatic. If the Fed had announced at any point along the way, because it felt it had to, because Treasury prices were falling, another $300 or $600 or $1 trillion of Treasury purchases, I am sure that we would be looking at 2 or more right now in the euro. And that would have a lot of bad effects everywhere, which we won't go into right now. So, at the time, as I said, the fear was quite current and logically sensible. And of course it also agreed with what the Chinese and the Russians, but primarily the Chinese, which is my topic, said they would do, or said they might do. But in fact, as we have seen, the Chinese did not do. The one thing the Chinese did not bring about was a collapse in the Treasury market. At the time, if it had happened, now as I said, the reason I call the Chinese responsible is because they are. And they're very well aware, as many other people are everywhere, one, of their weight in the world, and two, their own self-interests. It is my contention that despite what the Chinese have said, and I do believe they are concerned about the potential for the dollar to fall, that both their short-term and their long-term interests will keep them involved in the Treasury market for some time. I heard a report this morning on the way in that I think it was from the IMF, that the amount of world reserves, it didn't specify whether these were official reserves or private reserves, but most of these types of reserves are official, that means held by governments, held in dollars, went down, I think in September. No, it probably was August, but I'd have to check that. The percentage held in dollars went down to 62.8 from 65. That is a very large shift. So what is happening in the world? This goes back to the shift and the reasons for it from the pound to the dollar is taking place. And as it is sensible with our current world, which moves much quicker and which moves electronically rather than by steamship, it happens much faster than it used to. It took 50 years pretty much for the dollar to replace the pound as the world reserve currency. I have a feeling that whatever changes are ahead of us will take place much quicker. So, back to the topic. The Chinese near and far interests, although I will say they're very different, demand continued involvement in the U.S. Treasury market. There are a number of reasons for it. The near reasons are easy and have been discussed in many places and in many articles. The Chinese have an export-driven economy. They have said a number of times in I think the last 2 5-year plans, that their goal was to increase domestic consumption, but until very recently it actually hadn't. It actually had gone down a little bit. The U.S. economy, one of the striking facts of the U.S. economy, one is its size, of course, but two, is the fact that it's autarkic. That's an old-fashioned word which means it supports itself. Most of the U.S. economy, the greatest portion of it, is internally driven. That means by U.S. consumption and U.S. consumers. An economy like China, an economy like Germany, an economy like Japan, much more heavily dependent on exports. China is in that situation right now. But China, unlike Germany and perhaps Japan, Germany because its population is not that large. Japan because its population is declining. China, unlike them, and like the United States, has a vast internal market. You can make the case that the United States internal market is largely saturated. One of the reasons, both not only through the number of things that people have, you can only buy so many things after all, but to the degree that it's leveraged, giving it the ability to buy more. Certainly one of the problems of the past 10 years and more has been the degree of leverage in the United States. It was that leverage, which after all is borrowed money, which after all is what the United States as a whole is doing, which permitted the consumption of the United States, pulling goods from overseas. China, as an entity, as a country, as a society, and as a culture, still has tremendous material needs to fill, both in number, meaning people who want things, and in kind, in more and more things that the individual people want. So there is still a vast market in China. I feel assured that the Chinese economic planners and government know this. And they also know that the strength that can be had, as the United States has had for many years, from a vast internal market, produces the types of revenues for the government that turn into power. This is not an original observation on my part, but it is often true that these long-term trends are lost in the day-to-day hurly-burly trading, analysis, technical, whatever you do. And in fact, in some ways, they don't actually impinge on your trading decisions. Somebody's certainly not going to go long the dollar because of something that China is going to do in 10 years or where the Chinese are going to be. But there is a definite background to all that we do in our analysis. So, China's near-term interest, of course, is to support the U.S. Treasury market. One, they need to have their exports. Two, especially in the time frame of last spring and all of spring and early summer, when the world was still very worried and fraught with what had happened since prior September, any withdrawal of the Chinese from the market would have had disastrous effects on confidence around the world and financial confidence around the world. So they did not, and they are very sensible of the reasons. And despite what they said and their rhetoric, people looked at what they did. And when they did not withdraw, when they continued to participate, the reassurance has been quite substantial. Another good reason for the Chinese to participate is they do need to put all that money someplace. And the American Treasury market is by far the deepest, and it has enough liquidity to provide the type of purchases that the Chinese have. There is a certain reverse symmetry, of course, between the amount of, and this is not by chance, the amount of money that the Chinese need to invest and the amount of money that the U.S. needs to borrow. After all, in a grand or in a large economic sense, one is the mirror image of the other. The U.S. were not consuming well beyond its income, then the Chinese would not be selling as much as they do, and other places as well, of course, not just the Chinese. And I don't mean to focus on China. Well, I do mean to focus on China, but the reason I'm focusing on China is because it is an example of what's going on to a lesser degree in many other countries. And China, I believe, has, as a political entity, has world ambitions, as does the United States, and as the United States has exercised for many years. And that is where, of course, I'm ending up with this. Okay, so as I said, the Chinese have a number of quite a few reasons to participate. I went over a number of them. How shall I put this? The Chinese participation in what the U.S. were doing was as important to them probably as it was to us. Things did get a little dicey in China in the late winter and early spring. There were factory closings. There were people on the streets. People went home for Christmas. They didn't know what their jobs would be. Many of them lost their jobs. China has a great deal of concern and history of civil unrest. And this is certainly on the minds of the rulers in Beijing. So their economic stimulus seems to have been far more rapid and far more effective than the one in the United States. I really can't speak to the reasons for that, although I have my suspicions. Certainly some of the money has made its way into the property and the stock markets, and it has accounted for the tremendous rise in the Shanghai Exchange. But China has a vast surplus, which they are spending in the best Keynesian sense. Doesn't matter if they're just digging holes and filling them up again, and I assume they're not, because there is a great deal of infrastructure development in China that can still be done, and I'm sure the Chinese have accomplished it. But their purpose was, of course, to keep people working, and that they seem to have been rather successful in accomplishing. It is, of course, a little bit, you have to be a little bit wary of Chinese statistics. It's been long thought that the Chinese government thinks they need to have 8% growth a year just to absorb the potential for social unrest and the new people hitting the job market. And lo and behold, they come in with 7.9%. Be that as it may, it is certainly true that there has not been, at least reported, any great degree of social or domestic unrest due to people out of work, to lack of food, to the things that you might assume would go along with an economic collapse. So clearly that has not happened. So we now have a very clear vision of why the Chinese continue to participate in the U.S. debt markets, U.S. Treasury markets. It is in their clear immediate interest to do so. But I think it is also in their long-term competitive political and economic interest to do so as well. And these are my reasons. The Obama administration, its plans involve a tremendous increase in the United States debt burden. That cannot be accomplished, flat out, very simple, without the cooperation of the world's debt purchasers, and primarily the Chinese. Not mainly because the Chinese will buy it all, they won't, because the Chinese give the signals that many other places will follow. So if China, as we have said earlier, pulled out of the debt markets, there would be many problems. So it's looked to for that. But if the Chinese, as a world competitor, as a government of world competitors, concerned, now remember, China in some ways is like the United States. It has some resources. For instance, it has a great deal of coal, but it lacks others, which it must find on the world market, which it must influence other nations to provide contracts. At some point, it may perhaps find it necessary to provide military protection. After all, one of the reasons, not the only reason, but one of the reasons that world trade proceeds as relatively smoothly and piracy-free as it does is because the world's shipping lanes are largely guaranteed by the United States Navy. Not completely, but there's a direct parallel here to the 19th century and the 18th century, but primarily the 19th century and the British Royal Navy. If the U.S. can no longer afford to do that, and perhaps that day is approaching, will not local powers perhaps take their cut if they can, and will not that require a different Navy perhaps to enforce the world's shipping lanes? This is something 10 years, 20 years away, but it is not something that has escaped planners in China or the United States or other places around the world. The thing that concerns me, or the thing that interests me, shall we say, is that if there is a view in China and the United States towards competition on the world stage, politically and militarily. Then, for the United States, which is currently planning but has not done yet, and you know my opinion on this, I've said it before, to bury itself in debt and in the types of economic policies that will, I feel, seriously degrade the potential for growth in the United States if the U.S. is planning, or some people in the United States would plan, a European-style social democratic system. Those systems grow at far lesser rates than the United States has in the past. In addition, one thing that's certainly true of the last 50 years is one of the reasons the Europeans could afford their social democratic systems is because the defense was largely paid for by the United States. I know Europeans may disagree with me on this, but certainly in the competition with the Soviet Union, it was the United States which provided the largest degree of deterrence, not the European economies. So that permitted, of course, the Europeans to have a very robust social welfare program. You import that type of program to the United States, and I feel you will degrade the economic growth here. If you degrade the economic growth here, then you have less money to spend on things. That seems to be the plans of the current administration. We change our administrations quite frequently, so we don't know how this will last. But there could be no greater current check on these social democratic plans of the current administration than an abandonment of the world's bond buyers of the U.S. Treasury market. If that happened, led, say, by the Chinese, then the U.S. would have very little choice about where to go and what to do. The rates in the U.S. would rise, and U.S. spending plans would have to be curtailed. You are not going to get much curtailment out of Congress. It seems to be there is definitely something congenital, contracted in the American Congress that prevents them. Seems like it's something they get infected with as soon as they take their oath of service that prevents them from any substantial or realistic judgment of revenues and expenses. But the world's bond markets could certainly, in their own self-interest, not caring at all what DC does, enforce this type of fiscal rectitude on the U.S. government. If, and I do not say this is planned, but if this were led by the Chinese, then there is a possibility that given no other choice, the U.S. would have to be far more adult about its economy and about its spending habits in D.C. In the end, I feel, of course these are opinions, that the result would again be a vibrant and a much stronger U.S. economy. Again, my interpretation. So, and I do not say that, again, that this is a conscious effort on Beijing's part. Because again, I feel that their immediate interest and their own self-interest requires that they continue to participate in the U.S. Treasury markets to the degree that they are, and maybe even more. Nevertheless, by doing that, what they are doing is they are enabling the U.S. government to continue its incredibly profligate spending ways. If these ways continue for 5 years, or say the current administration serves 2 terms, or another 7 years, at the end of that time, the economic vibrancy of the U.S. and China will, I feel, be in stark contrast. And that is why I say, I'm being told to wrap up here, and I will. That is why I say, as I closed my column a few weeks ago in it, that even though the policies of the current administration, I'll be ending up shortly, will most likely, if they're enacted, lead to a relatively serious devaluation of the dollar, and I really do not see how this can be prevented if the current projections come to pass, even 50% of them come to pass. And believe me, to get the American Congress to withhold on 50% of spending would be a miracle, so I don't expect anything like that to happen. But even if they did, you would still get, I feel, a long-term decline in the U.S. dollar. The more it falls, the less its effect and the less people will use it as a reserve currency. This, of course, and this has been the focus of much of the public commentary, will affect the value of China's dollar and everyone else's dollar holdings. But would this not be, perhaps, a worthwhile price to pay for what would be a crippling of the American economy? Maybe not deliberate, but that debt creates more debt. That debt has to be paid. The money has to come from somewhere. The money can only come from American taxpayers or from exactions on the American economy. The more money you use to pay off your debt, the less money you have for anything else. Primarily the type of investment that creates jobs and economic growth. So it's my view, as I said earlier, that not only is China's short-term interest benefited by buying American treasuries and continuing to participate in the American debt market, but their long-term interests benefit as well, because it permits the U.S. government to continue its profoundly anti-growth policies. I know this has been a little bit more political than I normally do, and not entirely dwelling upon the dollar, but keep these types of things in mind when you are looking to not really maybe go into your positions, but to view the world in 5 or 10 years. Again, I thank you very much for attending. I hope this was informative, instructive, and perhaps enjoyable, although I don't guarantee that. And I will see you again next month. If anyone has any questions or any comments, I will put my email on the chat, and you can certainly write me or call me. Thank you very much for attending, and everyone, have a good day, please.